The most important tax item to get right is not April 15th. What it is year-round planning, especially if you're a retiree. Hi, I'm Scott Hamilton, Certified Financial Planner. We are fee-only fiduciaries. We have offices in Austin and Houston, and we help people plan for retirement. So today we're going to talk about some key concepts in retirement. We'll cover RMDs, Roth conversions, standard deductions, QCDs, a little bit about each of these, and roll it up into a nice package. Basically, the point is what's important with tax strategy is not just submitting your tax return, it's planning year-round. So RMDs, if you don't know what that is, you assume you work for a firm, you save up in a 401k, you roll that over to an IRA, which is what typically people do, and then so you work for a company, you got a deduction on the way in, right? And then on the way out, the government is going to get their share of the money back. So you got a deduction on the way out. So whenever you start taking withdrawals, it comes out as income. So it hits your adjusted gross income. So RMDs don't start until you're in between 73, 75. If you're born between 51 and 59, it's 73. And after 1960, it's age 75. So by the way, it's a large penalty if you miss it. It's like 25% can be corrected, but it's still, if you just don't pay it, it's 25%. So there's a ripple effect for these RMDs because a lot of my retirees, they come along and, if they've worked, they've saved, and the 401k built up, you convert it into an IRA, and then over time, you're starting to look at Social Security, the pensions, and RMDs. RMDs are insidious. They keep going up and up because, the government's going to get their money back. You went into a partnership with them 40 years ago, you got a deduction, and now they get their income back. Well, as a result, your tax rates are going to go up, and your tax bracket likely is going up, and so if you combine that with all the other things, the incomes, you end up owing more in taxes than a lot of times you ever expected. Sometimes you're making more money in retirement than you ever did working. I see that a lot with clients. So it's a ripple effect. RMDs, critical, they're key concepts. You can get out of an RMD, but it's called a Roth conversion. And to do a Roth conversion, you're literally just taking money out of your IRA that, is a 401k, you roll it to an IRA. You see that you've got RMDs over the years. So you've got a magic time frame, when you retire and then before you start taking RMDs. And this time frame is when your income is, in theory, lower. So that's a good time to do Roth conversions. And what you're doing there is taking a lump of cash out of the IRA and move it to the Roth IRA. Now, that is a taxable transaction. It hits your AGI on your tax return, adjusted gross income. So it's treated as earned income, if you will, almost, right? So it's taxed now, and you need to model this with an advisor, create a model. But in a lot of cases, many cases, it'll have, if you do Roth conversions, you end up with lower total cumulative taxes paid to the IRS legally, and a higher net worth terminal value. But everybody's different. It's not a clear-cut answer. It depends on how old you are, how much money you got, which accounts you're drawing down from in retirement. You have to have your drawdown strategy in place. Roth conversions are very important, very powerful. Now, let's move along to standard deductions. 2026, married filing jointly, $32,200, thanks to some recent bills that Congress has passed. It's very large, almost eliminated people itemizing for the most part. And then on top of that, if you're 65 plus, there's an additional, married filing jointly, $3,300. So if you combine the 32 plus the 33, and then, oh, by the way, there's a new, with courtesy of the One Big Beautiful Bill, an additional $6,000, married filing jointly, that ends in 2028. However, this one has a income limit in between 150 and 180. But nevertheless, you need to know the standard deductions and the fact that they're large, meaning that most people just don't really standard itemize anymore. They just take the standard deduction. And if you add the two tickers on top of it, it's $3,300 and $6,000. So you're ended up with a potential $47,500 standard deduction if you're married filing jointly with income under 180. And QCDs is number 4, the fourth topic. This is called qualified charitable donations, right? And we've got a variety of clients that use these. And if you're charitably inclined, not everybody is, but if you are, you can take from your RMD, you can just give a QCD to your favorite qualified charity, and it reduces your RMD dollar for dollar. It is a great way to pay your favorite charity instead of paying the IRS. And you can give up to $111,000 per person, but there is an age limit. You can't start this until you're later in your 70s. So there's a lot of key concepts about taxes that need to be done year-round, and frankly, they need a model to help you understand how they all fit together, because there's lots of moving pieces. So feel free to go to Hamilton Financial Planning, click on Schedule a Get Acquainted meeting, and I'd love to chat with you about your tax strategy, and how we can help. Anyway, thank you for taking the time to watch. Appreciate it.